Problem with real estate is illiquid. You can't just sell a bedroom to get some liquidity. Like, it's all or nothing. And you've also got businesses. You can't just chop off part of that to get liquidity.
That would be my worst fear is I put my two daughters. I don't write clear wishes or give enough flexibility where they have to fight because it was too, you guys decide after I die.
Yeah.
Most of the time doesn't work out well unless you ensure you've had family meetings, you've really discussed it. Just leaving a $12 million business that could be worth way more to 3 sons to figure out what to do with it, that could cause some fighting. They've lost their parent, and now there's a lot of money at stake.
The warm hand, cold hand problem.
Wait, I've never heard that term before.
You haven't?
What the fluff is that?
It's better to give gifts out of warm hands than cold hands.
Okay, yes, I agree with this. Oh, but that is just, okay.
Nice image to have in your head, isn't it?
Yeah, no, okay.
So this is a problem that hits people quickly. And if you're a high income earner in one of those states, you got to... If your wealth is growing and you're finding yourself with millions of dollars, you have likely an estate tax problem. We're going to dive into that, how to get around it and how to avoid it. Sit back, enjoy. Welcome back to another episode of Playbook of the Wealthy. My name is Dave Grant. My co-host is Heather Townsend. Today we are talking about estate tax law. It's going to be nerdy. If you don't like nerdy stuff, just skip to another episode. It's going to be a lot more fun. But you're likely going to get this problem in your lifetime. So before we dive into content, well, let's dive in.
Okay, so can I start out, just explain what we meant by this?
So I'm very excited.
I know, I'm very excited too. Well, okay, so the federal estate tax exemption is approximately 15, maybe it's going up to 16.
Yep.
It's large.
What does that even mean?
Okay, that means that if your estate, you pass away, it is over the 15 million threshold, your estate is taxed.
Okay.
Okay? What we see happening with our clients is, okay, maybe they're not hitting the federal estate exemption, but there's also this other part of the estate plan that people forget about called, sometimes the states that they live in want to collect estate tax. It was weird because Dave and I were just off the cuff having a conversation one day, and I was like, yeah, I'm dealing with this with one of my clients. They're, they're below the federal, but they have a state estate tax problem. And you're like, me too. And so what happened? We decided to do a podcast episode on this.
Right.
Because it's starting to affect our clients. So we imagine that there's many more clients or people out there that this is affecting.
And it's not many people at high estate levels in certain states. Oregon has a limit of $1 million.
That's low.
Well, Oregon real estate can get you to $1 million lickety split. So this is a problem that hits people quickly in certain states. And if you're a high income earner in one of those states, you got to address this fast.
So it's not every state. We'll go through some of them. Let's start with number 1, check if your state has an estate tax limit that is different than federal.
Most likely it is. There's not many states that are at 15 million. Are there any? I mean, there's some that are free. There's some that don't have any state taxes.
Yes.
And there's actually, the majority of them do not have state taxes. Only 12 states impose state taxes. But some of those states are pretty stringy. You're going from $1 million. Illinois is 4. That hasn't changed in decades. Arizona is...
I don't think Arizona has one.
I'll move there. But then you get up to, 13 million in Connecticut. So that's very close. You got a big range. And it just depends on where you are domiciled. That's going to pretty much be where it is. So the first problem we're really looking at, it's going to be the mismatch. Where are you living and what is the delta between the federal limit and the state limit, and what kind of problem do you find yourself in? Well,
and where this got me was Washington. So I have quite a few clients in Washington, and the limit is 3 million. To be technical, 3.076 million, right? So I'm like, well, I mean, do you know Washington, especially near Seattle, and their real estate prices? Like, it's hitting a lot of my clients. Let's talk about that. Then let's talk about the cliff, because I thought when you explained Illinois, how it works, that was mind-blowing to me. So explain what that means by a cliff.
Sure. So you've got the mismatch, but then if you are in Illinois, you're coming up against a limit of $4 million. That's going to be the amount that you can get away with leaving heirs, not paying any taxes. If you get to $4 million and $1, that $4 million becomes taxable as an estate. So it's not the $1, it's the $4 million and $1 that becomes taxable. Granted, it's a graded taxing schedule just based on how far you go over that. But it's wild to see that the whole estate becomes taxable.
Yeah, but once the estate becomes taxable, I imagine that causes compliance. I remember doing estate tax returns at Ernst & Young in my Big 4 days, right? Like they can be complicated. So you're adding complexity by that $1. Like, if you're really close to that range, you probably want to really do whatever you can to avoid going over the cliff and having to even have the estate tax problem.
Yeah. So I'm finding problems with high earners right now. And these are people who are earning great incomes, probably closer to 7-figure incomes, but they're in the mid-40s. And so we're having that discussion now of federally, you're fine. You can be fine for a long time. You're not dying in your 40s, heaven forbid, but you have a problem right now should you pass away. So we're going to have to start designing these estate docs as if you are about to die tomorrow and try and design all this complex stuff, knowing that it's probably not going to happen for decades. And we're going to have to be revising these forever and ever more. Okay,
so let's talk about that. So wait, there's something else on here you want to talk about. Lack of portability of the exemption.
Nerd alert.
Nerd alert. Nerd alert. Yeah. I didn't want to jump to, I like to, me, I like to talk to the solutions, but
yeah.
I think first we got to give the audience of all the things to think about. So there could have a cliff. So you need to know that. Is it just, hey, if you're over the limit, let's say for ease, like Illinois, hey, if it's 4 million, if you go over that dollar, then your whole estate gets taxed? Or is it anything over 4 or anything over the limit? Know that, right? So number 3 is this portability. And people, I know until I became in this world of finance, portability, what the fluff is that? That's like a complicated word. So it also applies to federal. If you are married, you can, let's say federally, you have an exemption of 15, you die, you can move that over to the spouse, right? You can carry it over, whatever the extra is. I did this with one of my clients, actually, when their spouse died. Well, the question is, does the state allow that? That's where you're going with this, right? And I'm finding that it differs completely by state.
Yeah. So usually that helps with an example. Let's run some numbers of if you have an estate of $20 million as a couple.
And we're just talking about state here, right? We're not talking about federal. Or are you giving a federal example?
Use a federal example first and then go to state.
Okay.
So federal, if you've got $20 million, each person has $15 million as an exemption. So if it's all in one person's name, yes, that's going to be an issue. If you're designing this well, you'd be able to transport some of the leftover, say you got $5 million left over of that, you can move that $5 million to your spouse so they don't have $15 million anymore. They've got $20 million in exemption. And so that estate can then grow even further and still pass tax-free.
Yes.
If they're in Illinois and you got a $20 million estate, you've got problems for days, but still. You've got $4 million each. And I'm going to caveat it because rules change all the time, you may not be able to move that $4 million to your spouse. Once you pass away, and if you've planned correctly or incorrectly, that $4 million disappears. And that $4 million is just left for your spouse. You can't add on to it. And if you've not used any, make your spouse have 8 by doubling up.
Well, so it's interesting as you talking about this. In Washington, we figured out that there is no portability election.
Okay.
So some states don't have them. So that's where one of my clients that we were dealing with this, and they're not young, they're more retired, that we were like, whoa, we got to figure out something because I mean, even just alone in their real estate, which, that's growing. They're probably not going to sell their house. Their house alone, by the time they pass away, could be over the $3 million.
Yeah, for sure.
So, and we don't have a portability election. Oh boy. So I can't wait to talk about our solution that we came up with.
Not yet.
I know. You aren't going to like. Okay.
Got more problems here. Problems for days.
Okay, let's get through the problems.
You spoke about real estate.
Yes.
The problem with real estate is illiquid. You can't just sell a bedroom to get some liquidity. It's all or nothing. And you've also got businesses. You can't just chop off part of that to get liquidity. Are you selling this whole business to be liquid? Because that's a problem. If you're having an estate tax issue and you've got real estate of 3 million, a business that's 15 million, obviously we're talking big numbers. Well, if you're 18 million right there, that's just 2 assets that you can't just turn around tomorrow and just start carving up.
This is the thing with estate lawyers. And if you are meeting with one and you have these problems, you can tell a good one from a bad one very quickly. It's just like there are good financial advisors and there are bad financial advisors, good CPAs, bad CPAs. If an estate planner does not, or a lawyer does not understand the tax implications and liquidity and is not thinking about that when it's designing an estate plan, that drives me fluffing bananas. It makes me so mad. They really love making these pretty documents, some of them, but they don't think through how it actually gets carried out.
Yeah.
You'll get Heather on a soapbox with that.
It's a lot of compliance. It's not a lot of planning.
Yeah, you need to have the estate planner and hopefully a financial advisor walking you through understanding how is this actually going to be carried out if we put this in? How's that going to affect everyone and your wishes?
Yeah. Well, that feeds into the last problem, which is if you've got these illiquid assets in multiple states. Most common is real estate for retirees. So if you've got your main house in Florida, no estate tax there. If you've got your secondary house in Illinois, you thought you were out of the woods because you lived in Florida and domiciled there. You're really not. Illinois is going to come along and say, well, you passed away and you had some real estate in our state. So that becomes partially taxable. It's part of your estate because it's in Illinois. We want the tax dollars because you had some real estate there.
And I would imagine, I mean, I don't know, again, I'm not a lawyer, but I would imagine each state differs on that, whether they include just in the state or if it's your whole estate. I wonder. I don't know.
Illinois, it's the assets in your estate if your estate has gone over the Illinois tax exemption amount, and then they'll look to collect taxes on it. But it's just wild that if you never lived there and that was your vacation home, that's going to start to get taxed.
Okay, so I think our listeners now understand that estate taxes in your state you need to pay attention to, and if this is a thing, you could have some problems. Okay? I like solutions.
You do.
So let's talk through the solutions. You know, federally, you can give per person $19,000
this year,
2026, without ever having to file a gift tax return. There's no gift taxes. There's nothing. Now, I've had clients do this. You can gift more than that. You just have to file the gift tax return. It's really just an informational return. The CPA is going to charge you something to file it, but it's pretty easy, and you can work towards your federal exemption. Just know if you're doing over 19 per person. If you're married, though, so like me and my husband could give my daughter, what is that, $38,000 a year, and our other daughter $38,000 a year because it's 19 per person.
Yep.
That is one way. If you're doing that every year, if you have multiple grandchildren, if you have kids, I mean, you can start, and you're married, that's $38,000 you can start giving to every person in your family that you want to. You can start kind of chipping away at that every year. If you did that over 10 years, that can be a lot of money.
Yeah, I mean, you can be doing $100,000 a year easily between you and your spouse. And then as soon as a grandbaby pops out, take 38 grand.
Yeah.
Well, it's nothing. Come on now. It's a push gift.
Hey, my one of my clients, they're so lucky. Let's just say they have some really wealthy grandparents, and their kids that they just had have some 6 figures and 529s already.
Goodness.
I am like, oh, that would be so nice. Okay, keep going.
So I do a gift tax return each year for one of my older clients just by doing this, because it's not an estate tax problem. It's more of this is the weird term, the warm hand, cold hand problem.
Wait, I've never heard that term before.
You haven't?
What the fluff is that?
It's better to give gifts out of warm hands than cold hands.
Oh, it's like the Die with Zero book.
Yeah.
Okay, yes. I agree with this.
And so
but that is just, okay.
Nice image to have in your head.
Yeah, no, okay. Sticks.
It was easier when she was married to her husband. Husband is now passed. But now it comes a case of she still wants to give the same amount, but that means that it doesn't go as far because technically it's called gift splitting when you do it with your spouse. So the same amount goes out, but it's now we have to file tax paperwork because the husband's not around and it goes over the exemption. So there was an old structure probably 20 years ago. It was called an AB trust. And it was one that was used when the federal exemption was really low. Essentially, it's creating a trust between the spouses and then a trust between the married couple and the children. So you're essentially, when the first person passes away, you're giving as much as you can to your spouse because there's no limit. You're not giving as much as you can. You can move as much as you can to your spouse because there's no limit to gift between spouses. So what you're trying to do is you're trying to use the marital exemption as much as you can. And then...
So federally, that would be like 15 million. So people can follow, right? So they're like trying to give the 15 million, and then anything over the 15 million
goes into the B trust, which is for children. You can, if the A trust runs dry, you can then tap that for the spouse. But technically, it's supposed to split this inheritance up between the spouse and the children, while also trying to get around really low tax limits on the estate tax side.
And you're seeing this even in the state, just regular state area. So it's interesting that you bring this up. It just dawned on me. I actually have a client that has an AB trust because their business is growing so fast that we're like, oh, we could in 5-10 years have this problem. So let's just bake it in so we have the option.
Well, the interesting thing is this almost disappeared as a strategy because the estate federally limit just kept rising and rising and rising. And it just was like, well, why do we need this if the limit that we can give to whoever is 10 million now, next year it's 12 and then it's 13. But because these states haven't caught up, now it's becoming a state problem where it's not a federal problem. So it's becoming more popular.
So AB trust, the one we did, which I really liked, is called a disclaimer trust. Currently, my client's net worth is over the state tax exemption. And basically what happens is when the first spouse dies, because you don't know who's going to die first, right? You disclaim the part of the inheritance into an irrevocable trust. That is over the limit, right?
Irrevocable trust is one you can never change again.
So, but the reason that I like this is the distributions can be used for the spouse from the irrevocable trust. So they can manage the investments, they can sell real estate, all of that. It must be done after 9 months after death. So you have to disclaim part of the inheritance within 9 months. So I actually was walking this through the client. This is what I mean of playing it out. I was like, okay, we know the rule of no one should make, and this is good for anyone, but if you have a big event happen to you emotionally, someone dies, something like that, you really shouldn't make any big financial decisions for 6 months. So I was thinking through that. I was like, great. For 6 months, will start thinking through what we should do. Then we'll have 3 months to actually do it when they've grieved.
Sure.
So I actually like the 9 months. There's not an option to add more funds after it.
Okay.
That's key. This is the part that I had to ask the attorney, because again, the attorney wasn't giving a lot of details. I had to drive this. But once you disclaim, when it goes to their kids after the second spouse dies, no step up in basis.
Well, that's a downer right there.
So, right there, I started thinking, okay, when this happens, I need to be very strategic. Put the least growing assets in the disclaimer trust, and the ones that are probably going to grow the most keep on the outside, but I have to keep it without going above the estate tax exemption again in the state, right? So there's going to be a lot of planning.
This is a puzzle.
It is a puzzle. I literally have in my notes for this client of, all right, this is how I should think through it. Because, now it's fresh as I just was going through the estate. But these are the things I should start considering. Anyways, I'm not going to go into the weeds too much on this. But I know. But what I liked about this disclaimer trust is we also have the option to not use it.
Okay.
So what I said to them is I was like, let's just put it in there so we have the option. So if we're over the estate tax limit, we determine that this is the best route to save taxes and the way we're going to gift the most to your kids, we have the option to use it whenever one of you passes. Because we don't know where your estate will be. We don't know where the estate tax exemption will be. We now have the option. And I love options. So we added it. Okay.
All right. The last one as a solution. This is pretty good for business owners. And I have a couple notes here. I'm just going to stick to one. So we're going to talk about, you mentioned irrevocable trusts that you can't change after things have been put into place. You can have an irrevocable trust that holds life insurance.
Yes.
So it's called an ILIT. So it's an irrevocable life insurance trust. Let's say you've got a business that is worth $12 million and it's growing really fast. When you die, you're going to pass it to your kids and you don't want them to have to sell the business in order to get the funds to pay the estate tax. You can put life insurance in a trust and it's on your life. So when you die, that life insurance pays out the benefit to the trust. And then when you die, that life insurance becomes available to the kids. So essentially, they use that life insurance proceeds to pay the estate tax. The business stays in place and can continue to run past your passing, and no one has to touch the business to tear it apart.
That's where I think permanent life insurance makes sense, by the way. Like,
yeah.
That's why I say it's a wealthy tool. It's stupid wealthy tool. Yes.
Has minimal need before that. The other things are a little bit too weedy for this. So I don't really want to go in it today because I think we have exhausted people's ears. All right, we need a Heather bow here.
Okay, you need a bow. So I first want to start out that Dave and I are not lawyers. So this was not legal advice. We were just talking through, hey, we noticed this with our clients that, hey, maybe everyone's talking about the federal exemption, but states matter. Instead, you need to look up your state. Did we say that there's 12 states that have a state tax exemption? Okay, we did say that. There are many options, which we talked through. My bow is you need to start with what your goal is in the end. And I know that that's not the funnest thing to talk about, but if you know what you want your kids to inherit or what you want the charities, that really helps craft the plan. And knowing what you need today, you might have extra now that you could be gifting now and avoid this altogether. So just really know your numbers, know what you have today, know what your intentions are, and a really good financial advisor and estate planning attorney working together will be able to craft a good plan for you. The other last thing I want to say on a bow, especially for your 40-year-old clients, one of my estate planning attorneys made such a good point. You don't want to do anything too permanent, especially with young people, because things can change. And so that is the last thing I can do. That's why I wanted you to hear my example on my clients. Even though they're in their 60s, they could live for another 30, 40 years.
Yeah.
We put an option in there. We didn't make anything permanent.
That's good.
Okay. I thought that was a great bow.
All right. If you've got any nuggets from this episode, we need something in return. So that's going to be a like, a comment, a follow, subscribe. If you're on YouTube, there's a new feature called Hype. That gives us points that pushes our episode out to more people. Love it if we could start using that. Maybe you could be the first one that does it on our video. Maybe. You also need to send this to your mom. She's getting older. She's going to die. We're all going to die, Heather. Just send it to someone. All right, moving into our next section of the podcast. It is called What Would You Do? All right, question section of the podcast. Heather, you are queued up on the first question. Take it away.
I'm 45, single, and my estate is already at 3.5 million, growing by 250,000 each year. I'm in a state where the estate tax free limit is 4 million. This sounds like an Illinois client.
Maybe.
What do you suggest I do?
It's funny how this sounds very similar to a client that I have. So I think the first thing is going to be talk to an attorney. They know designs of estates. They are aware of procedures and designs that they can use even when you're young like this. Like you said in your bow, don't do anything permanent, but make sure that your attorney is aware that this is going to be an ongoing problem. Put them in touch with your financial advisor and make sure that all those strategies are working together as you progress through 50s, 60s, 70s. And you may die tomorrow. That's no one's promised tomorrow. So make sure it's all set up just in case that happens.
And know what your intentions are. Like, I completely agree with you. I'd just add, know what your intentions are. If, like, communicate that to the lawyer too and you. If something happened to you today, what would you want with your money? Where would you want it to go? Question
number 2. My wife and I are 85. We own real estate in 3 states.
Uh-oh.
Our total estate is $6 million. Our domicile state, where we spend the most time, is Florida, but we have assets in states that have low estate tax limits. We've yet to finalize our estate planning documents. Any initial recommendations?
I mean, every time I hear this, I actually talked to a prospect the other day. This is a great example. And they were like, well, we live in Arizona, but we have a house in, I don't know, name a state. I think it was Wisconsin. They didn't have a trust. Like, I was like, your kids, they got free advice from me right there. I was like, your kids would have a probate nightmare right there. And so let me give an example. So these people have three real estate in 3 states. If you do not have a revocable trust, whoever you're giving your assets to is going to have to go through probate in those 3 states.
Gross.
And that can be $10,000 to $20,000 minimum with probate.
as well as traveling across the country multiple times.
And you could pay $3,000 to have a revocable trust and avoid the whole thing.
Mm-hmm.
So you need a revocable trust so you can avoid probate for your loved ones. That's number one. The other one is you need to meet with an attorney that also understands that thinks big picture of like, how are all of these state taxes, what are their different implications, and how's that going to affect your plan having these real estate in these 3 different states?
Mm-hmm.
And what can you do? What do you need to design to avoid the limits?
Well, when I saw this question, when they were like, we have got 3 real estate in 3 states and our estate is 6 million, I'm like, that might be a real estate heavy estate right there. Mm-hmm. You may have
illiquid.
$1 million liquid and all the rest is in real estate. Well, you kind of need to flip that, because if you're going to be starting to hit estate tax in multiple states, they're going to require liquidity from the get-go that you're going to pay these estate taxes before that estate is finalized. You as a couple need to become more liquid, whether that's selling the real estate here to get a more liquid estate, putting in life insurance, that'll be crazy expensive at 85. But leaving this alone as it is just going to create a problem.
Mm-hmm. Yeah. I am 70 and most of my net worth is in my business to the tune of $12 million. I am leaving it to my 3 sons. I don't care what they do with it when I pass, but I'd like for them to not be forced to sell at my death. I have plenty of free cash each year from the business. What should I do?
Good one. This one can go a lot of different directions, because it's, business is $12 million. Obviously, that's going to be a problem state-wise if you're in a state with an estate tax problem. But if your business is growing, you're probably going to have a federal problem as well, because you're only 70. So that's where an irrevocable life insurance trust could be really helpful here. But you're also not forcing your children to keep the business. Like, if they want to sell it, they can, but you don't want them to be forced to. So yes, have that insurance trust there. It doesn't need to be a huge amount, because if they want to sell the business to pay the tax too, then they can do that too. If you've also got free cash flow from the business can pay for their life insurance. So it can pay the premiums, and then it doesn't hurt anybody while you're still alive.
I'd really want to see how, as an advisor, if this was my client, I'd be asking some really deep questions on how is the relationship between the 3 sons. Mm-hmm. And I'm going to give an example of why. One of my guy friends, he's an advisor. His wife has a cabin that's a family cabin. The trust pays for all the siblings to keep the cabin. Mm-hmm. But some of them don't want the cabin. They'd rather have the trust funds for themselves to use for their ideal life. So it actually is like a rift between the siblings, mm-hmm. because some of them use the cabin and love it, and some of them don't.
Yeah.
And what if one son really wants to run the business, the other 2 don't? Like, you could create, like, that would be my worst fear, is I put my 2 daughters in, I don't write clear wishes or give enough flexibility or whatever. I don't, where mm-hmm. they have to fight because it was too, you guys decide after I die.
Yeah.
That most of the time doesn't work out well unless you ensure you've had family meetings, you've really discussed it. I mean, you really need to have some in-depth meetings. Just leaving a $12 million business that could be worth way more to 3 sons to figure out what to do with it. Mm-hmm. Even if you leave enough optionality, that could cause some fighting. It is interesting when people are emotional. They've lost their parent.
Yeah.
And now there's a lot of money at stake.
We take that to the next step, because now I'm getting into the weeds of this problem. Okay. All right. So let's say that one of them wants to run the business, 2 don't care for it. Mm-hmm. So leave the business to 1, take the cash flow that is not needed to run the business to buy life insurance on your life, which will be the inheritance for the other kids. Mm-hmm. Granted, if you've got a $12 million business, you've obviously got money outside. So then that gets parceled out to the other kids, knowing that this one child who likes the business, that is your inheritance.
But you needed to know that, right?
Exactly.
You had to have the conversations with the 3 sons. You wanted to have, like, you got ahead of it versus they'll figure it out, mm-hmm. like, very different, right? And this might be a good family limited partnership too, like option, TBD.
Yeah.
Okay. All right. We went way down a rabbit hole on that one.
Could do that for hours. Moving into the next section of our podcast, this is called highlights. All right. Highlights is where we talk about personal stuff. Mm-hmm. I went down a rabbit hole fitness-wise recently. as to say, okay, what if by the end of the summer, I wanted to be at X weight? What does my eating habits need to look like? And what does my exercise habits need to look like?
Am I rubbing off on you with my stats going to the gym?
That fed it. You know, I've done a triathlon before.
I did not know that. That's impressive. Right. Okay.
Granted, it was a sprint triathlon. It took me 2 hours.
Does that mean you swam?
Mm-hmm.
Impressive. Okay, keep going.
So the feedback I got back was not exciting. It was like, all right, you're going to break your walking up into 3 walks a day and you're going to hit 7 miles a day. I'm like, no, I'm not.
It's a lot of miles.
That's like, who has the time to do 7 miles in a day?
What if you got one of those standing desks with the...
And did that?
What if... No one can see what I'm doing.
Crawled on it.
But you know what I'm saying? The walking treadmill. Mm-hmm. You could probably get 7 miles. I can't think when I'm standing up on my standing desk.
I would probably fall off the treadmill as I'm trying to type.
Yeah.
But yeah, I would say I'm not going to hit that 7 miles every day. It's more likely going to be 3 to 4 miles, 3 to 4 times a week. So that's better than, I mean, granted, my fitness journey falls off in the winter. It's so cold. It's so dark. I just want to curl up on the couch. But this is going to be better than nothing.
So you're doing your 7 miles and breaking it up in 3?
Absolutely not.
So what are you doing?
Probably 3 to 4 times a week, 3 to 4 miles.
I think that's great. Okay. I'm excited. I'm excited to hear your journey as we're both getting into this health fitness journey together. All right.
What you got?
Mine's funny. I literally had to laugh at myself. So the girls brought home pumpkin seeds.
Okay.
And they went out in our backyard because we had a tree fall down. We got it cut out. So there's this like one opening in our turf. We live in Arizona, so we have turf, not real grass. But there's dirt. And they decided to plant the pumpkin seeds there. I was like, this is harmless. Nothing's going to happen. And then I was like, well, I'll even help. We'll put real good dirt that I use for my pots in there.
Yeah.
We have multiple weeds coming out of this area within 5 days. They are watering it every day. And Alex is laughing at me so hard because I'm like, am I about to have a pumpkin patch in my backyard? The girls are growing fluffing pumpkins. It's working. And I can't say no. And we have a very perfectly landscaped backyard. Pumpkins would not fit it.
Have you grown pumpkins before?
No, I don't know anything of what I'm doing. My extent of gardening is potted flowers.
These will take over your pool. It's not going to stay where it is. It's going to go wide and far.
What do you mean? Like there's going to be vines going everywhere? Is that what you mean?
It depends how good your soil is, how they're cultivating it. Yeah, good luck.
So this is a problem.
If they take, pumpkins can be hard to grow.
Okay, that's
depending
what I
on
was
the conditions. Because I'm like, how are you going to grow pumpkins in the desert?
Well, it's happening. I don't know.
Yeah.
I'm hoping it just gets so hot that then, we go away for the summer but they're growing really fast. I mean, within 1 week, we have 2 inches of weeds off the ground.
Well, that's the weeds, right? Are you talking like they're literal weeds or they're actually the pumpkin sprouts?
They're the pumpkin sprouts.
Okay.
And there are multiple of them. Like probably 20.
Good luck.
Okay, that's my highlight.
Pumpkin's really good for dogs who have sensitive stomachs.
Oh, we give Peanut pumpkin. My daughter also loves pumpkin.
Okay. So it's going to be natural dog food for the next 7 years.
So I don't know. I might take my nice lounge chairs out of the backyard and let pumpkins grow. This is where I'm like, the Heather in me of parenthood is actually a beautiful thing because it kind of just lets me, I'm like, this is the chaos that I want. And I'm going to it's not going to be a pretty backyard, but I might go on this experiment of having a pumpkin patch in the backyard.
You just have to let go of the reins, don't you?
Yes.
Like, it's going to be what it's going to be.
Yes.
All right. Well, thank you for listening to this episode of Playbook of the Wealthy. If you want to keep listening to us on audio platforms, we're everywhere you can find us. If you want to watch the video, you can multiple places. We are YouTube, Instagram, Spotify, and now the Apple Podcast is doing video too. We are there as well. If you want to look at our website and see what's there, it's playbookotw.com. And then from there, you can email us. We are at hello@playbookotw.com and send us your feedback and your questions. And we'll see you next time.
I love your questions. Please email them in. Again, go to our website and toodles!
All opinions expressed by Dave Grant and Heather Townsend are solely their own opinions and do not reflect the views of their respective wealth management firms. This podcast is for informational purposes only, should not be relied upon for investment decisions. Nothing in this material constitutes a solicitation for the sale or purchase of any securities. Clients of Retirement Matters and Townsend Financial may maintain positions in the securities discussed in this podcast.